Okay, let's unpack this. We've got a really interesting mix of sources today. It feels like they're bridging, well, two pretty different worlds.
Yeah, definitely. On one hand, you have this community-driven crypto space, specifically coming out of the Pi network, PiBazar Community Hub.
Right. And then, bam, we're talking about traditional, regulated European brokerage platforms.
Exactly. And the sources aren't really digging into Pi itself, like the tech or the coin value. Instead, they're highlighting a specific sponsored thing happening within that ecosystem.
A financial opportunity, basically.
Yeah, a chance for those community members to maybe dip their toes into traditional investing.
So our mission here seems pretty clear. The sources talk about getting free shares, right? And they call the whole thing advantageous and safe.
That's the core claim.
So we need to, really dig into that. Is the platform offering this actually legit? And crucially for you listening, is it genuinely safe? Are there real protections?
Let's tackle the advantageous part first. What's the actual offer?
Okay, so it's this promotion on a platform called Trading 2 and 12. They're offering free shares, apparently worth up to 100 euros.
Up to €100. Yeah.
And the sources frame it as like super fast, super easy to get started with traditional investing.
That speed element seems key. The promo itself, it's only running for about a month, give or take.
Right, a limited window.
And once you actually sign up, you've only got 10 days. Just 10 days to do whatever's needed to grab those free shares.
That definitely creates a sense of urgency, doesn't it? It makes it feel, I don't know, more real.
Yeah, tangible. So how easy is it? What's the catch?
Well, according to the source material, the barrier is like almost zero. You just need to register through a specific link, a referral link.
Okay, standard promo stuff.
And then this is the bit that stands out. You only need to deposit a tiny amount, like really tiny. The source mentions something like 30 Czech koruna.
30 koruna, that's what, just over €1?
Exactly.
Yeah.
Or the equivalent in whatever your currency is.
Wow.
Oh,
That's strategically low. It's
yeah.
not really about the money then, is it?
Doesn't seem like it.
It feels more like it's just getting you over that first hurdle. Most big brokers, they want hundreds, maybe thousands, just to open an account.
Yeah, this basically removes that whole financial barrier. But hang on a sec. If the idea is to let people try trading risk-free, why even ask for that 30 koruna? Why not just give the share? Seems a bit odd.
That's a fair question. It probably comes down to compliance, legal stuff.
Oh, okay.
By making you deposit even that tiny amount and linking it to, say, a verified bank account, they tick a couple of boxes. First, KYC, know your customer.
Right, verifying who you are.
And AML, anti-money laundering checks. Linking it to a funded account helps with that. Plus, it confirms you actually have a way to get money out later.
It's like withdrawing the value of that free share or any profits you might make down the line.
Exactly. It turns someone just looking into an actual verified user instantly.
So it's friction, but like the absolute minimum friction needed.
Seems that way.
The source material is definitely positive about it, calls it a great way to try trading risk-free because it's a verified promo. And it doesn't stop there, does it? The advantage grows.
Right. Once you've got your share, you can apparently get more by inviting friends.
Ah, the referral loop.
Yeah, which makes total sense why it would pop up in a community platform like PiBazar. It taps into those existing networks, makes the whole thing kind of viral, potentially.
Okay, so that's the advantageous part. Low barrier, potential for free value, referral bonuses, but an offer's only good if the company behind it is solid.
Absolutely. Now we need to pivot to safety, legitimacy, especially for an audience maybe coming from crypto, where, skepticism about centralized platforms is pretty high.
We need rock-solid proof here.
What's interesting is the source material itself mentions doing some initial checks. It notes that, Trading 212 seems to be a legitimate brokerage firm.
Okay, that's a start. What else do we know?
They've been around a while, founded in 2004.
2004. Wow, so
Yeah.
that's over 20 years in the investment game.
20 years. That kind of longevity, it says something. It means they've weathered financial storms, outlasted a lot of flash-in-the-pan operations.
That definitely builds some trust. And the sources mention its reputation too, right? Being easy to use.
Yeah, apparently known for being beginner-friendly, which fits with the low deposit thing.
Yeah.
They also offer fractional shares.
Meaning you don't have to buy a whole share of, say, Apple or something expensive. You can buy a slice.
Exactly. Makes it way more accessible for people starting out with smaller amounts.
Okay, history is good, reputation is good. But the real test, especially for finance, is regulation, isn't it?
Always. History doesn't mean much without proper oversight. If they're making it this easy to get in, The regulation needs to be absolutely watertight.
So who regulates them? The sources list quite a few.
They do. It looks like they're covered across different places. You've got the FCA in the UK,
Okay, the Financial Conduct Authority? Heard of them?
CISCC in Cyprus,
Cyprus Securities and Exchange Commission?
the FSC in Bulgaria, and even ASIC down in Australia.
Wow, that's a lot. Why so many? And which one really counts for, keeping things safe for users?
Well, having multiple licenses lets them operate legally across different regions in Europe and beyond. It's pretty standard for big brokers. But the big one, the one that's often seen as the sort of gold standard,
Let me guess, the FCA.
you got it. The UK's FCA. Being regulated by them means adhering to some really strict rules. We're talking capital requirements, how they handle client money, transparency. It's tough.
So having that FCA stamp carries a lot of weight, more than just being regulated in one smaller place.
Definitely elevates their credibility.
Yeah.
And the sources seem to back this up, suggesting that this level of oversight has led to a pretty clean track record.
Meaning no major scandals or big regulatory blow-ups?
Apparently not. Which, for a company operating that long and at that scale, is actually quite telling. Suggests they take compliance seriously.
Okay, so that covers the legitimacy. Looks solid. Now let's really double-click on safety features. For someone maybe used to crypto's not your keys, not your coins idea, what specific protections does a regulated platform like this offer?
Right. If we connect this to the bigger picture, these features are all about tackling the risks of a broker failing, which isn't really a concern in pure decentralized systems, but it's absolutely critical for centralized ones.
Makes sense.
The first big one is how they handle your money. Client fund segregation.
Okay, I've heard that term, segregated accounts. But what does that actually mean if I deposit my, say, 30 Karuna or maybe a bit more?
Think of it like this. Trading 212 can't just use your deposit as their own cash. It doesn't go into their main bank account to pay salaries or office rent.
Okay.
Instead, it goes into a separate, dedicated account held at major independent banks. Big names like Barclays or JP Morgan are often mentioned.
So it's ring-fenced, completely separate.
Exactly. Legally separate. So if Trading 212 itself were to, say, go bankrupt tomorrow.
Which is always a risk with any company.
Right. But your money in that segregated account shouldn't be touched by their creditors. It's still legally yours.
That's a huge safety net. And then there's insurance on top of that, right? Compensation schemes.
Yes. This kicks in if the broker or potentially even the bank holding the segregated funds fails completely.
What are the limits? What should you know?
Because they operate across the UK and EU, there are sort of two main layers mentioned. Through the UK's FCA setup, you're protected up to 85,000 sterling.
85,000 pounds, okay.
And under the EU rules, via CISC in Cyprus, the coverage is up to 20,000 euros.
20,000 euros. So significant amounts, covering most small investors easily. It guarantees you get something back even in a worst-case scenario.
Precisely. It's about protecting the retail investor from catastrophic failure.
Okay, so that's financial safety. What about, like, digital security? Hackers getting into my account. We mentioned KYCML before, but what else?
Well, on the tech side, they use things like advanced SSL encryption for data.
Yeah.
Fairly standard now, but still important. But crucially, they offer security features that you control. You can, and probably should, activate two-factor authentication 2FA.
Like getting a code on your phone when you log in.
Exactly. Or using biometric login like fingerprint or Face ID.
Yeah.
That makes it much, much harder for someone to get into your account, even if they somehow got your password.
And the regulators, the FCA and others, they keep checking this stuff.
Oh, yeah. They're subject to regular, mandatory external audits, compliance checks. It's not a one-off approval. It's ongoing scrutiny.
Okay, this next one feels really important, especially for someone completely new, maybe a bit nervous. The sources mention protection against a negative balance. Can you explain why that's such a big deal?
Ah, yes. This is genuinely a game changer, particularly if you compare it to, say, some types of leverage trading in less regulated spaces where you can end up owing money.
Right.
Negative balance protection is a guarantee from the broker. It means your account balance physically cannot go below zero, ever.
So let's say I put in 100 here. I buy some shares with it. The market crashes unexpectedly. My shares might become worthless. I lose my 100 euro.
Yes, you could lose your initial capital.
But I will never get a bill from Trading 212 saying, hey, the market moves so fast, you now owe us an extra 50 euro.
Exactly that. Your maximum possible loss is strictly limited to the amount you deposited. full stop.
Wow. For a beginner, that must remove a massive amount of fear, the fear of getting into debt just by trying things out.
It's probably one of the single biggest psychological safety nets they offer. It means you can explore, maybe make mistakes, without risking more than you put in. Combine that with the KYC we talked about, and their teams looking out for dodgy activity, it builds a protective environment.
It really sounds like all these things together, the segregation, the insurance, the 2FA, and especially that negative balance protection, they create this cumulative effect.
Which seems to be why the source material reaches that strong conclusion about safety.
Right. The source confidently calls Trading 212 one of the safest platforms for small investors in Europe.
Indeed. Based on these features, that statement seems pretty well supported. It confirms the second part of the initial claim. The action isn't just potentially advantageous with the free shares, it appears fundamentally safe because of this robust regulatory framework and the specific investor safeguards in place.
Okay, let's try and wrap this up. Let's synthesize the key takeaways for you, the listener. We started with this specific offer. Free shares, super low entry found within the Pi network community.
Yeah, a time-sensitive promo. We then looked at the company behind it, Trading 212. Found they have a long history, over 20 years.
And crucially, they're operating under serious regulation, multiple bodies, but especially the UK's FCA, which is a big deal for credibility.
Then we really zeroed in on the safety aspects. Your funds, they're kept separate, segregated.
Right, and insured up to pretty high limits in both the EU and UK.
Plus you have tech safeguards like 2FA that you can enable. And maybe most importantly for newcomers.
That negative balance protection, guaranteeing you can't lose more than you put in. No risk of ending up in debt from trading.
Right. So this offer, popping up in a place like PiBazar, it effectively acts as a very well-protected bridge, maybe, into the world of traditional regulated finance.
Okay, so let's pull back for a final thought. We noted that the Pi network community, where this whole thing originated in our sources, is itself really focused on its own security challenges, like rolling out fast-track KYC to verify millions of users.
A huge task for them.
So here's something to maybe mull over. We see regulated platforms like Trading 212 building trust and attracting users, partly because of their strict compliance and safety nets, right?
Yeah, that trust is built on regulation.
So the question for you is, how might the successful rollout of strong, verifiable security protocols, things like reliable KYC, effective anti-fraud measures within decentralized ecosystems like Pi Network, how might that ultimately boost user confidence and maybe accelerate participation in that wider, borderless digital economy?
It really points to the idea that whether it's centralized finance or decentralized, security and verifiable identity, they seem to be the absolute keys, don't they? The keys to getting broader trust and real mass adoption.